On this video, I'm going to finish off looking at different demand-side policies being put in place, deciding whether they are fiscal policy or monetary policy, and what they're going to do to aggregate demand. So there are two more here. Interest rates decrease. So interest rates changing is to do with monetary policy. And if interest rates decrease, remember, rate of interest. There are always three things to think about. So borrowing, if the rate of interest is lower, will go up because people don't have to pay so much interest on the loans that they take out. And therefore, the reason people are borrowing is to consume, so consumption will go up, and firms often borrow to pay for machinery, so they're buying more capital and investment goes up. Also, interest rates are linked to saving. If interest rates go down, people will earn less interest on savings that they put in the bank. So saving will go down. If people aren't saving their money, they must be spending their money. So for consumers, consumption will go up. For firms, if they're not saving their profits, they're more likely to be spending them, and investment goes up. The last one is if people or if firms have existing loans. If the existing loan has a variable rate of interest on it, that means that if the base rate set by the Monetary Policy Committee in the UK decreases, then the amount of interest that they have to pay on their existing loan also decreases. So every month they'll be paying less money on the loan that they already have. And if they're having to spend less money on that loan, it leaves them with more money left over for consumption, so that can go up if it's an individual with a loan, or if you're a firm with a loan, you're going to be able to invest more because you're spending less on the existing loans. So we can see here consumption's going up, investment's going up. And we know that aggregate demand, if consumption goes up and investment goes up, if all of these other things stay the same, then aggregate demand will go up. And therefore, this is expansionary monetary policy. The last one here is government austerity. Austerity means if you're being austere, you're being strict. This is where government spending goes down. The government aren't spending so much. This is what happened in the financial crisis when the UK government decided that whilst we were in the financial crisis, also our national debt was too high and the deficit was too high. The government was spending more money than it was collecting. So they decided to introduce government austerity, part of which was decreasing government spending. This is what people called the cuts, and some of those are still going on today. And it can also mean increasing taxation. And if these two things happen, we're going to have less money that's in the circular flow of income. Because remember that government spending normally would be an injection. So if we have less government spending, less money is coming into the circular flow of income. Also, taxation is in the circular flow of income a leakage. And if we have more leakages, then again there is less money in the circular flow. All of these things are going to cause, obviously, government spending is going down, but also if there's less money in the system via the multiplier effect negatively, we'll also have less consumption, less investment. And therefore, overall, our aggregate demand is going to go down. And because this is about government spending and taxation, it's about fiscal policy. And if aggregate demand is going down, this is contractionary fiscal policy.